The contentious angel tax is set to be on its way out. That's one of the recommendations made by the Ministry of Commerce to the Ministry of Finance in run-up to the budget day. Industry watchers are of the belief that this move is likely to bring considerable relief to both early-stage startups as well as the investors. What is angel tax and why has it got the entire startup community up in arms with the government? Let's find out. Angel tax is simply an income tax which is levied at the rate of 30.6% when an unlisted company issues shares to an investor at a price which is higher than its fair market value. Essentially, it's the tax on investments made in a company which is over fair market value, and it taxes that as income. Well, that brings us to the question, how does one really calculate the fair market value of a company? The sum total of the market value of all tangible and intangible assets held by a startup or closely held company is its fair market value. Therefore, when an unlisted startup gets equity investments from residents of India for the issue of shares that exceed their fair value, the excess amount is subject to income tax at the rate of 30.6% under the heading income from other sources for that particular financial year, and that is the angel tax. So why has the angel tax been introduced in the first place if it's retrograde? Well, it was introduced in 2012 in order to deter generation and use of unaccounted money through the subscription of shares of a closely held company. Sounds fair, but why has it suddenly become an impediment for startups? Well, to understand that, let's look at the phrase fair market value. The angel tax becomes an additional liability on startups which are receiving investments above the company's fair market value. The investments are really the lifelines of early stage startups which are grappling with consistent funding for survival in a highly competitive market and business environment. Now, startups by definition are required to cover a huge distance in their break-even journeys in a very short time. Constant funding, when money is being spent on market capture and customer acquisition, becomes a matter of life and death for startup companies. An additional burden of 30.6 only makes things worse in an overly cutthroat competitive marketplace. If things were not bad enough, in 2023, this tax was extended to investments from non-resident Indians as well. Well, some relief was provided by the government in 2019 with an exemption from this angel tax so long as the turnover of the startup was over 100 crore rupees and the paid-up capital and share premium did not exceed 25 crore rupees. Businesses take time to hit 100 crore rupees turnover target. The relief obviously failed to provide any relief to entrepreneurs. With unicorns drying up, there have been just 3 new ones in 2024 so far. The removal of angel tax could be that game changer that startup ecosystem has been waiting for a while.